Welcome to This Explainer. Today we're diving into a genuinely fascinating business phenomenon. Every single year the headlines are completely dominated by the world's biggest publicly traded corporations. But we're going to flip the script. We're looking in the exact opposite direction to figure out why some of the most foundational, wildly successful companies on the planet actually avoid the stock market altogether. And we'll see how staying in the shadows might literally be their ultimate competitive advantage. Okay, so let's set the stage with the massive household names we all know. Apple, Microsoft, Nvidia, Amazon, Tesla, right? Their stock prices are analyzed every single second of the day. Quarterly earnings basically run the financial news cycle. And honestly, every single strategic move their executives make is picked apart by millions of investors around the globe. For most of us, this is the picture of absolute business success.
But here is where it gets really interesting. Quietly, totally behind the scenes, there's another group of companies building absolute fortunes without attracting a fraction of that attention. You can't buy their shares, and honestly, most people rarely even hear their names. Yet, they consistently outplay their publicly traded rivals. Which brings us to the big question. Why on earth would a wildly successful company actively turn away public money and all that hype?
Section 1. The hidden giants, operating in the shadows of the market.
Logically speaking, an IPO sounds like the ultimate business dream, right? You get access to billions in capital, the founders get a massive payday, employees get those lucrative stock options, and your brand gets insane global visibility. Actually, fun fact, private companies make up the vast majority of the global economy, controlling trillions in wealth. But still, it's wild that some of the absolute strongest businesses out there take one look at all these public perks and deliberately lock the door.
Let's move to Section 2, the ultimate asset and the true cost of public capital.
So walking away from billions of dollars really comes down to understanding the hidden cost of that cash. And it all boils down to one simple, incredibly powerful word: control. Take the Mars family, for example. They've built one of the absolute biggest food and candy empires on Earth. By staying private, they keep complete, unbreakable authority to steer their ship. See, the second a company goes public, ownership splinters among millions of shareholders. Suddenly, the executives aren't just answering to customers or employees anymore, they're answering to activist investors and hedge funds, demanding instant, visible returns.
And when your ownership is sliced up like that, executives are thrown into this grueling, endless 3-month hamster wheel. First, you've got the quarterly earnings report, immediately followed by the dreaded analyst conference call, which instantly spins up a whole new round of investor expectations. Just missing one single quarterly forecast can literally erase billions in market value overnight. That kind of massive pressure completely warps decision-making, and honestly, it's something you, the end consumer, can often feel directly in the quality of the products you buy.
Which leads us to Section 3, the power of patience, or thinking in decades, not quarters.
Because when you manage to escape that punishing earnings calendar, leadership gets their hands on something incredibly rare: time. Time to actually invest, time to experiment, and, this is absolutely crucial, time to recover from a short-term failure without facing a wall of public backlash and a totally tanked stock price. That level of patience is a massive competitive advantage.
Just think about massive family-owned titans, right? Companies like Rolex or IKEA. They've dominated their industries for generations specifically because they think in decades instead of quarters. For them, the goal isn't just pumping up this year's share price. It's about bulletproofing the business for the next generation. It completely shifts the playbook. When a private company pours money into deep employee training, or decades of research, or ironclad supplier relationships, it usually translates into better, more reliable products for us. Those kinds of things can take years to show a financial return, and staying private makes waiting it out so much easier.
If we break down the day-to-day realities, the contrast is pretty stark. Public companies are often totally bogged down by complex governance, board oversight, and tons of regulations. Meanwhile, private companies can just pivot on a dime, which is huge when technology is changing this fast. Also, public companies are forced to broadcast their revenue, their risks, and their entire strategy to the world, stuff competitors study obsessively. Private companies, they hold those cards close to the chest, giving them a massive information advantage. And culturally, they have the freedom to protect their craftsmanship without Wall Street analysts constantly breathing down their necks.
We also see a night and day difference in how leadership actually spends their time. Public executives are constantly fighting market distractions. They spend huge chunks of their day on investor meetings, earnings calls, and analyst conferences. Honestly, public CEOs kind of turn into full-time financial marketers. Private executives, on the other hand, actually get to run their companies.
They get the luxury of devoting their time directly to operations, customers, and product development, the stuff that actually makes the business tick.
Moving on to Section 4, the tale of two CEOs and how incentives drive completely different decisions.
Now, real quick, I should point out that staying private isn't exactly easy. Growth costs money, and for tech companies that need massive amounts of capital for research, going public absolutely makes strategic sense sometimes. But the psychology behind it is what we're focused on here. See, public markets heavily reward visible, immediate growth. Private markets, they reward sustainable, long-term growth.
So imagine this scenario. You've got two CEOs, one public, one private, and they're both looking at a 20-year investment timeline. They found this incredible project that will tank their profits for 3 straight years, but it's guaranteed to generate exceptional, market-dominating returns over the next 2 decades. The private CEO looks at that long-term payoff and signs off on it immediately. Done. But the public CEO, they are sweating bullets. They have to worry about furious investors, missed analyst estimates, hostile boards, and a plunging stock price during that entire 3-year dip. Neither approach is necessarily wrong, but they are clearly playing 2 totally different games based on their incentives.
Section 5. Playing the long game. Durability over daily headlines.
Another massive edge for private companies is simply ownership stability. Out in the public market, shares are bought and sold constantly, but private ownership stays locked in. It's really fascinating when you look at the world's largest industrial suppliers, titans like Cargill or Koch Industries. They rely completely on this exact stability. These are the guys making the basic components in your car, the chemicals under your sink, the logistics systems dropping packages at your door. They operate totally out of the spotlight, dominating these massive niche markets. It just proves that to be a foundational business, you don't need celebrity, you just need to be excellent.
Ultimately, the crucial takeaway here is that businesses optimize for whatever they are measured against. And look, private ownership isn't some magic guarantee. Plenty of private companies fail every year because of bad strategy. But the core difference is those incentives. Public companies are practically hardwired to optimize for shareholder value that is instantly visible on the market. Private companies? They optimize for durability, independence, and long-term resilience.
Bigger isn't always better, right? And adding millions of investors definitely doesn't guarantee better decisions. So I want to leave you with this to chew on. In a business world that is just completely obsessed with noise, publicity, and chasing the next quarterly headline, maybe the absolute greatest asset a company can have is the freedom to just ignore all of it. The freedom to build patiently, to quietly get better year after year, and to play the long game while nobody is even paying attention.